All right, all right. So that was a good discussion on NFTs and also fintech and AI. But now let's move forward to our next presentation with our guest speaker, Patrick Ceresna from Big Picture Trading, and also longtime MX instructor. That's a great combination. Now, in his presentation, Pat will show us how we can maximize income returns by using the wheel strategy. The wheel strategy sounds pretty intriguing. So let's find out what it's all about. Patrick, I'm going to stop my screen share and it's all yours. Please enjoy.
Hello, everyone, and thank you for joining us for the presentation on the wheel strategy. My name is Patrick Ceresna from Big Picture Trading, and many of you may know me from Macro Voices or the Market Huddle. And I wanted to cover this strategy of how to create consistent income and returns in your portfolio through premium harvesting or through income. And it's an important process to put some thought into in terms of how we can do this on a systematic basis. What most of us know as covered call writing or the selling of put options is really a trade. When we turn around and sell a covered call on a stock or sell a put, there's a defined period of time and we make a very specific outcome to that particular trade. But when we put it in the context of a portfolio, so I have $1 million portfolio and I'm doing covered call writing within that portfolio to generate income, or I'm doing it on an ongoing basis, so over the course of a year or two as a part of my portfolio, then we have to have a bigger strategy around the covered call rather than the individual trade. And the wheel strategy is one of the ways that we can approach income selling, and I want to explore this with a little bit more detail for all of you. So let's jump right into it. We're going to do a lot more practical stuff because we don't want to just talk about what is a covered call and what is a put, but then actually go through the actual exercise of what it is to go through managing the trade after you sell it, what happens at expiration, what are the pitfalls, what are the different scenarios when the trade is working versus not working. And so we're going to cover all of this in greater detail here. So let's jump straight into this. So we're going to first start off by having the conversation about absolute returns through option writing. And one of the things that I want to highlight is the fact that most returns from a stock market perspective are driven through asset allocation as well as from market correlation. What I mean by that is that everyone goes and stylizes their portfolio, buys this ETF, this stock, this individual security, and they create their basket. But as an aggregate, when the whole stock market rises, think of it like the tide coming in the ocean. All ships rise with a rising tide. In the same way, if we had a 10% advance in the entire stock market, what we would often have is that most of your portfolios would be up 8 to 12% or something a little underperforming or overperforming depending on the assets you picked. But generally, much of your return is being driven by that market correlation. And what I feel so strongly about is the fact that option premium harvesting is a type of diversification method that allows you to create uncorrelated returns that do not rely on the markets rising or falling in order for you to generate your returns. You're creating the returns very similar to the way a dividend investor or something else will by creating an income stream. And the wheel strategy is a really interesting way of approaching this. And so we'll talk about that. So let's put a little more context on this and put a little perspective on returns. So when an investor buys a traditional investment, let's just use an ETF. So let's say you're buying the XIU, which represents the Canadian TSX 60, and you just buy it, and let's say you pay $25 a share. I'm just making up a number. And so the question is, once you buy it, answer the questions: how much return are you going to make on this investment? How long is it going to take you to make that return? In the end, your investor is hoping that it turns a profit, but the future outcome is quite uncertain in terms of how you're going to get from point A to point B. And so with that perspective there, what I do want to point out is that when we are option premium harvesters, we have more certainties. When I sell a premium in the options market, I know upfront how much cash flow I'm going to make. If I turn around and sell someone for a 5% premium for 3 months, a covered call, or sell a put and make that 5%, I know that in my hand I have 5% return that I made, and I know it's going to take me 3 months to make this cash flow. The stock might go up, the stock might go down, but this premium was received and earned, and it's going to take me 3 months to earn that 5% premium. And so this allows this portion of the portfolio to make money irrespective of what the market is actually doing. This is so important. So this is not a debate or or a case that one should do premium harvesting instead of investing. One of the things that we're really trying to get across is the idea that in a diversified portfolio, and you have your allocation to bonds, and you have your allocation to indices, and you have your allocation to all your different asset classes, commodities, or anything else that you're investing in, that there's a place for the option income strategy as a part of that diversified portfolio. And so one of the reasons why this is so important is just this very example right here. So I just like, this is a complete oversimplification, but to me, it graphically just illustrates and allows people to visualize where the diversifier comes in. So when we buy any standard investment, you're relying on its appreciation over time as its primary mechanism making a return. And so in this circumstance, when you buy a standard investment, let's say an ETF, you're profitable once that investment is modestly going up or significantly goes up. You become profitable in that scenario. But even if the investment remains unchanged, goes down a little or goes down a lot, you've lost the opportunity to make money, because if you held it for 6 months or a year and that investment didn't appreciate and remain the same, it's an opportunity lost to have earned a return somewhere else. And when we are a premium harvester using strategies such as the wheel strategy, you are profitable whether the stock goes up a lot, goes up a little, stays the same, or even goes down a little. And the only circumstance where you find the market more challenging is when the market is going down considerably. And so what happens is that when we're doing any income strategy associated with this, you actually put the probabilities in your favor, where you're able to actually be more consistent with your returns because you're not relying on the appreciation of the market to create those returns. And so we're going to look at this with real examples and really try to put context into this. So what we want to do is talk about this wheel strategy. And the wheel strategy is really creating a methodology around a combination of put selling and covered call writing. Now, this particular strategy, the wheel strategy, needs to be done in a margin account. That's because this selling of puts is something that is not eligible in an RSP or a TFSA. So you would have to focus purely more on a covered call writing approach in a registered account. But assuming that we're now talking specifically about a margin account, and we're going to combine put selling with covered call writing, and the goal is to consistently grab income premium, and to for a prudent investor, it's a way to diversify. Well, the goal, of course, is to diversify this strategy amongst a number of securities. It's important that you don't want to just pick one stock and be doing the wheel strategy on one stock, because doing so puts concentration risk in it, and it allows you, it takes away your ability to do tactical repair on a position that doesn't work. Well, we'll talk about that in a moment when we give an actual example of what that looks like. But really what it comes down to, it's a combination of the two strategies, which is we're going to turn around and sell puts on stocks that we're willing to own. And this is the key. We're willing to own as a part of our portfolio strategy and earn the income and keep repeating this process until we are assigned, which is when we sell a put option, we undertake the obligation to buy the shares. And inevitably, if we do this enough times, we're going to inevitably be assigned on the shares, and the shares will be put to us, and we're going to have to physically own them. But once we have the shares in our ownership, we then begin the process of covered call writing on them and earning income through covered call writing. And we repeat this process until we're forced to sell the shares, inevitably, and we then begin the process of selling the puts again. And it's a repeated process of just not worrying about whether the stock is going up or down, but the consistent process of going into the market and grabbing income premium over and over again to generate the returns on our investment. So I want to actually go through the examples. And in order to do that, we just need to do a quick review of the two different types of strategies, covered call writing and put selling. So very quickly, covered call writing involves us physically owning the shares. We'll do examples of this in a moment. And we physically own them. So you can, in your current investment portfolio, you can take any of the Canadian stocks. You have some, let's say you have shares of Suncor, you have shares of one of the big Canadian ETFs, or you have shares of Barrick Gold, or any one of these Canadian stocks or Canadian bank stock. You can, if you already own it, at any one time, you can begin to be a covered call writer. You can sell a call and be paid a cash premium up front for giving a speculator the right to be able to buy your shares from you at a specific price over a specific period of time. And so let's say we have a $10 stock and you sell $11 strike covered call. For the next 2 months, you have given the speculator the right to be able to buy these shares from you at $11 at any point over these 2 months. So that's a covered call. It creates a payoff profile that basically has this hockey stick curve, which is essentially we cut off the upside potential of the earnings of the stock for a guaranteed income premium. Now, again, what I want to emphasize, and I want everyone to reflect upon this, is that we're doing this only on a portion of the stocks in our portfolio. So let's just say, for the sake of rounding, we say we have $1 million portfolio. And what we're doing is we say we're going to allocate $250,000 or 25% of the portfolio to premium harvesting. That means that $750,000 of that $1 million portfolio owns the stocks that are long the equity on the upside. So a lot of people that get the anxiety that you're cutting off the upside understand that you have a component of your investment portfolio that is already invested on the appreciation of the stock market over the longer term. And therefore, if you're very bullish a stock that you feel has a big upside, you would own it in your investment component of your portfolio. The goal of the income or wheel strategy, or this part of your portfolio, is to generate income enhancement for your portfolio through the premium harvesting, which is not about capturing the big upside of a stock. It's the analogy of bird in hand versus two in the bush. Question is, if I gave you the choice right now to have the certainty of making a 10% cash flow return in the next 1 year, or you might make 0, but you might also make 20%. Well, you're taking a risk that you might walk away with nothing, but you could make 20%. But for some investors, taking the guaranteed 10% up front, the bird in hand versus two in the bush, is an important way of approaching investing. And so somebody that is using this strategy wants more certainty and is forfeiting right tail upside on the stock market for that certainty of what they're getting today. And so in this circumstance, the covered calls, the most equities and ETF options have these calls on them that, and for the majority of them, they are American style settlement. An American style settlement means that physically shares must be delivered if we're held to assignment. And therefore, this is a strategy that involves the buying and selling of securities, and you want to accept that as the part of the wheel strategy. Inevitably, losing the shares is a process of you then regaining them back through put selling. And so we'll talk about that right now. So the shares are physically delivered on assignment, and while you own the shares, you are receiving the dividend. There's always the risk of an early assignment on an ex-dividend date and other variables. We can talk about that a little bit later during the Q&A. But during the period that you're covered call writing, you own the shares and therefore earn the dividends. So now this strategy is combined together with the selling of puts. And the selling of put options is in my an important process of also earning an income and for the chance that you're going to get the assignment of a stock. So now in this circumstance, we don't own the shares. So in the covered call writing example I gave earlier, we physically own the shares. And when we're selling put options, we don't own the shares, but we undertake the obligation to have to potentially buy them in the future at a specific price over a specific period of time. And so what we do is we earn an income for having agreed to allow someone else to sell us their shares at a specific price. A lot of people equate this to the selling of insurance. In the end, what we've done is we're selling someone an insurance policy to for the downside of the market, and we're being paid a premium for doing this. And so the payoff profile has a very similar look to that of the covered call, which is essentially we have a limited upside to the premium we received for the put, and we have the downside risk of the underlying security. And so the process of the wheel strategy is the combination of covered call writing with the put selling. And so we're going to explain the process here in detail. In this circumstance, the cash covered versus naked, and this is very important to be able to highlight the differences. A cash covered put is when we have the cash allocated to the side that if someone forced us to buy the shares, we actually had the money set aside to actually buy those shares. And that's so important to think about it that way. In the end, what we're trying to do is harvest a guaranteed certain premium and a return on our cash. And so what we're doing is we're allocating the cash to selling the put, and we go through the process of selling it. Now, there are circumstances which we're going to demonstrate in the pitfalls and repair strategies on what we can do under different circumstances. But there are situations where we may sell a put option naked. And selling a put option naked is where the investor is now using the excess margin available in their account as the collateral to potentially having to own the shares, versus actually having the cash aside already allocated to that assignment risk. And this is an important distinction, because what I will demonstrate in a moment is that there is very little that is actually risky about put selling. What is risky is leverage in put selling. In other words, if I had $100,000 and I go to my favorite Canadian bank stocks and sell $100,000 of notional assignment risk on Canadian banks, and then the Canadian banks go down and all of those stocks are put to me, well, I had the money to buy them. I had the money to buy them at more favorable prices, and now I'm an owner of those bank stocks like any other investor. My risk at that moment for selling the put was no different on the downside than somebody who already owns the shares. So where is the risk in selling the puts? Well, if I had $100,000 in cash and I turned around and sold $300,000 of notional put assignment risk on Canadian bank stocks, and suddenly we had some market event and the Canadian bank stocks went and dropped 30% in their value. Well, now the risk wasn't that the put was dangerous. The risk was in the fact that I leveraged myself and I had more assignment risk than I was prepared to undertake. And this is very important in the management of the wheel strategy, because what I want to talk to all of you about in the wheel strategy is not the idea of, as a speculator, leveraging up your returns to make this big cash flow at the risk of all the leverage. What we're trying to demonstrate is the income process of using covered call writing and put selling to generate cash flow returns. And leverage is a choice that does not have to be deployed or can be utilized if you as an investor have a higher tolerance towards risk and or feel this is a tactical moment in the market where deploying some leverage would make sense. And so just a very quick highlight in terms of the calculation of margin. When we determine when you sell a put option, how much cash on a margin basis has to be allocated, you have to take the actual value of the option plus 20% of the market value of the underlying security minus the amount that it's out of the money. This is a base case minimum requirement that is required by the industry for you to maintain this position. Now, certain brokerages do reserve the right to be for them to be charging a higher margin than this base minimum. But most brokerages will use this type of a calculation to determine what is the margin value. And so I want to just quickly highlight some of the differences between covered call writing and put selling to dispel some of the misconceptions toward the strategies. So commonly, stereotypes for put selling, many people commonly view them as risky. And so it is not uncommon. If you in your mind said selling puts was risky, that is a common stereotype. And one of the things that contributes to that is the fact that most brokerages require additional options approvals for you to be able to do naked option selling. And because of that entire process, it is often very easy to associate that with a riskier strategy. But I want to talk about it at its core fundamental comparison rather than the stereotype that comes with it. When we go back to this risk profile chart that we showed earlier, we can see that this is the risk profile for put selling versus covered call writing, and you can see that it's actually the same risk reward profile. I'm going to really emphasize this. In the end, they're both short gamma strategies that involve you selling and harvesting premium. And so I give an example this way. So we have a $10 stock. So we have this XYZ stock trading at $10 with no scheduled dividend. And we're going to compare a put call parity scenario of we're selling an at the money $10 covered call. So the first top line is the idea of physically buying the shares at $10 and selling a covered call on it for 70 cents at the $10 strike. And what I want to point out is that that 70-cent premium you earned, or 7% return on your $10 position, is the exact same 70 cents that you would earn having alternatively sold a $10 put option for 70 cents. And your delta is actually synthetically same. Your theta burn is going to be the same. Theta being the rate of the time decay on the option, which, because you're short gamma, that's actually the rate of which you are profitable on the trade. And the implied volatilities, because of put call parity, would also be equal. The point is that the outcome is the same. What is your break even on both trades. If I buy the stock for $10 and earn a 70-cent income premium from a covered call, and that's a guaranteed 70-cent income, that means my break even or average cost base is $9.30. That means that that I don't start losing money until it's below $9.30, because no matter what, with the stock goes down, I get to keep the 70-cent income no matter what. In the same way, if we sell a $10 put option for 70 cents and the stock goes down, my break even is still $9.30, the same break even for the covered call writer. The point I'm trying to get across in here is that that the process of selling a covered call at the money versus the idea of selling a put at the money, they're actually mathematically and synthetically identical to each other. And this is why alternating from one to the other is actually a key part of this process. Now, many people will push back on this, and the common misunderstanding is saying, well, somebody who owns the shares, a covered call writer selling the calls, actually will own the stocks and therefore collect the dividend on the shares, while a put seller doesn't receive the dividend. This is a misconception or misunderstanding that needs to be made clear. From the option pricing model, dividends are actually being discounted into the option price. And therefore, if an option expiration cycle is overlapping a known dividend, a scheduled dividend, then what you will see is the probability adjusted dividend is discounted into the put versus the call, and therefore there is no opportunity arbitrage between the two. You basically are synthetically earning the dividend through the more robust or richer put premium and earning a less of a call premium because you're scheduled to earn the dividend. And so all of that is actually being mathematically discounted into the option pricing model. And so another common argument for covered call writers is, well, a covered call writer can sell a higher strike call and therefore have some equity upside. So I could buy this $10 stock and sell $11 strike covered call and have a 10% upside on the stock up to $11 before I lose it, while with a put, I don't get that upside. But that also is an incorrect statement, because arguably, so we're back to the same $10 strike, the $10 stock. And this time we're going to do the covered call out of the money. So in this circumstance, we have a $11 covered call earning a 30-cent premium. And that means we have a $1 upside, and our break even on the security is $9.70. But to do the synthetic, or to do the similar option, a 3-month $11 in the money put, which would earn you the same 30 cents of time value plus $1 of intrinsic value because you're selling the put in the money, will actually give you the same $9.70 break even. And if the stock was to rally and be at $11 or higher, then the put option would earn you the same $1.30 return that the covered call writer would. The point is that it's not that covered call writing is better or put selling is better. They're actually mathematically the same. And one has to simply understand that you're alternating from one of the strategies to the other is not increase or decrease your risk. You're actually, in some manner or another, synthetically doing the same strategy. So let's actually do an example of the wheel strategy. So here we have XYZ stock trading at $10. We're pricing it at an implied volatility of 40%. And we're going to, for the sake of simplicity, say this stock has no dividend. And so we start off the process of selling put options to collect a premium. So we allocate the cash. In this case, we're selling 10 puts on this $10 stock. So in our portfolio, we're allocating $10,000 cash aside in a money market fund for the chance that we may have the stock, the put may be assigned, and we may be obligated to buy the underlying security. And so we're going to keep the cash earmarked on the side saying this is allocated to these puts if we, throughout this process. So we earn in this situation a $500 premium income for selling this. Now that is that same kind of income that a covered call writer is making. It's $500 cash that was paid to us, a 5% return that we made. Now, under scenario one, if the stock closes at $10 or higher, we earn a 5% return as the put expires, and we made 5% in that specified period of time. But we would then, as a part of the wheel strategy, repeat the process, and we would just again sell another put, maybe for another 50 cents, and then earn another 5% income return. And we would keep doing this inevitably till the put is assigned to us. So under scenario two, which is the scenario of assignment, or assignment risk anyway, is where the stock in the situation drops below $10. So in this situation, the investor has two choices. We either are going to roll the put forward or take the assignment of the stock. And so taking the assignment of the stock is going to be the same process of owning the shares as a covered call writer would. So let's go through the two scenarios. So scenario one of rolling, let's say the stock closes at $9.75 at expiration. And so the original $10 strike put is now trading at 30 cents. So remember, we originally received 50 cents for that put. Now, days before its expiration or at expiration, there's 25 cents of intrinsic value, and odds are we're going to have to give a little bit of premium to the market maker to close it. So we're going to just say it's a 30-cent put option. But now going one new month out, that $10 put option for one additional month is 65 cents because it also has the same 25 cents of intrinsic value. And so right before the expiration, the process of rolling is basically closing the old put for 30 cents, selling the new put 30 days out for 65 cents. And we are up now a net 35 cents more premium. On top of our original 50-cent premium, we're now 2 income rights in and have earned 85 cents net on an accumulated basis. And so rolling is the process of not taking on the assignment, but simply extending the put forward. Now, alternatively, we could just take the assignment of the stock. So alternatively, the stock is trading at $9.75, and we are now assigned 1,000 shares at $10. And so our new adjusted cost base of these shares is $9.50 because the 50-cent income we sold the put for was earned irrespective of it. So while we had an assignment risk at $10, we got paid 50 cents for selling the put. Our adjusted cost base, or break even, is $9.50. Now, a new covered call selling 30 days out, let's say, earns us 35 cents premium at the $10 strike. So now what we've done is we've taken on the assignment of the stock and we begin to be covered call writers. And we now go through the process of selling covered calls. And we would do this process over and over again, earning every single month income premium. And so we would then, in this case, earn $350 premium. Now notice that $350 premium plus the $500 premium we earned gives us the same $850 or the same 85-cent premium that the person that was rolling earned. In the end, these are actually just synthetically different ways to execute this process. And so the wheel strategy is the process of perpetually grabbing income premium over and over again, month after month out of the market. So what are the pitfalls to these strategies? What could go wrong? And how do you repair a situation that goes wrong? So let's talk about this. So in this example, we have a very bullish market that you may have in your favorite stock is running away from you. So the stock is just going up every single month, and you're selling the put saying, I want to be assigned the stock. But yet the stock goes from 10 to 11 to 12 to 13 to 14. And every month you sell a premium at 11, sell a premium at 12, you sell a premium at 13, and you're earning this income as you're going. But because the only place to get the premium is somewhere near where the stock is trading, inevitably you're increasing your strike prices of where you're selling the puts. And inevitably, something that is rising rapidly to the upside often gets caught in a market correction on the other side. And so one of the risks to the wheel strategy is that if you're selling these puts and chasing what your favorite stock higher, inevitably you may get caught in that correction. But the second pitfall is the idea of getting caught in a rapid market drop. And so let's say you sell a put option on a stock and it has a bad earnings announcement, and or so the market has some sort of a nasty event. In the end, the stock rapidly drops, and you as an investor have to make an important choice. Do I just cut the loss that I have incurred on the selling of the put, or do I repair the position? Do I basically try to find a way to manage my way through this trade? And the decision depends on the quality of your stock. You can basically say, well, look, yeah, the stock went down, but it's still an amazing stock. I think it will come back. My investment thesis hasn't changed on it. It's just I'm set back on the short term. Well, if that's the case, you're going to want to repair the position. But if you alternatively have a situation where the stock actually had something fundamentally wrong happen to it, you may be put in a situation where you might have to cut the loss on the position. And that is a part of the investing and trading process as well. We as investors and traders inevitably run into those circumstances. But let's talk about the idea of repairing. So let's assume that the stock still meets all your investment criteria, and there's no reason why you want to abandon this position right now. So now as well, in order to repair a position, and why I say that it's important to be somewhat diversified amongst a number of stocks to do this, so that you have excess capital and or insufficient margin to be able to repair a position. So let's go through the process of how do we repair a position that has gone against us. So let's talk about a situation where we collect the original example where we have a 30-day $10 strike put that we collected a 50-cent premium on. This is the original position that we talked about, $9.50 break even. In this situation, there's an earnings disappointment, and the stock rapidly wipes out 30% of its value and goes from $10 down to $7 in this very disappointing drop. And you are now assigned the shares. You earmarked this $10,000 towards this position. And you said, if it's put to me, I will buy it. And suddenly the stock drops, and you now have an obligation to buy the shares at $10, even though it's selling at $7. Your break even or your adjusted cost base is now $9.50. But worse off is that to sell covered calls on this position up at the $9 and $10 strikes, there may be very little to no reasonable call premium available up there. So you're in a situation where you're stuck with the stock. Now, an example of the repair strategy is the equivalent of dollar cost averaging on your position. So our investor now owns 1,000 shares at a break even of $9.50, and a new $7 30-day put option is trading for 40 cents. So now our investor turns around and sells 10 additional puts for $400. Now, if you wanted to stay consistent with the notional equal amount, you might sell 12 or 13 puts. So that's an additional $10,000 of potential assignment risk. So you're dollar cost averaging an equal dollar amount. But the point here is that you sell a new 40-cent premium and receive a new $400 premium at the $7 strike, in addition to the 1,000 shares that you already own. The idea here is that if the stock stays at $7 or higher, you get to keep that 40-cent premium, and you've now reduced your break-even or adjusted cost base in repairing the trade down to $9.10, and then you repeat this process again. Now, but under scenario 2, if the stock was below $7 and it continues to drop, you could go back to our original decision tree, which is we can either roll the put forward, or take on the assignment at $7 and dollar cost average our position lower. And so, so in this situation, let's say the stock closes at $6.75. And we now are assigned this new 1,000 shares, in addition to the original 1,000 shares we owned, at $7. So our new average cost base on 2,000 shares is $8.05, because our first 1,000 shares had a break even of $9.50, and the second 1,000 shares had an average cost or break even of $6.60. And so we now have a scenario where we bringing our break even or average cost base down. This allows you to turn around and basically roll up your position, or at least get to your break even. Now you only need to rally from the stock from 675 back to 8 in order to be at your break even. And you could even begin covered call writing at $8. And it gives you that opportunity to adjust your trade. And so in this circumstance, the process of going from covered call writing to put selling back to covered call writing is a process of you just allocating a part of your portfolio to always earning cash flow out of the market. And I kind of give you a bigger picture view of this. Let's just say that you consider, look, there's going to be a period where stocks are going to drop rapidly. And there's a period where stocks may even rise rapidly and go through this entire whipsaw of markets higher and lower. But I want you to just go through a thought process. If over the course of several years, whether it's 2 years, 3 years, 5 years, you go through the process of extracting a premium of month after month, after a certain amount of time, you are going to earn 100% of the value of the underlying principal in premium. It's just because in the process of collecting and harvesting income, you're guaranteed to grab premium over and over again every single month. Inevitably, you're going to reach the point where you are going to have earned more premium than the entire value of the stock. And it's about the consistency of doing this. And it's, again, I want to just make sure it's really important to emphasize, this is not about saying this replaces your long equity part of your portfolio, but this, as a diversified portfolio, having a certain part of your investment portfolio dedicated to absolute returns through premium harvesting, and let's say it's a 25% allocation of a portfolio, this allows you to diversify where your returns are coming from. And it creates a portfolio that isn't entirely reliant on the market appreciating to make your returns. And that is an actual, an important way of approaching the investing and trading process. And so to me, this is a very valuable thing, and it's something that everyone should have in their investment portfolios. I clearly didn't leave enough time for question and answers, but we're approaching the period at the end here. And nonetheless, I hope all of you got some value out of all of this. This is the kind of things that I do a big picture trading and talk about on the podcast and through options trading, and what I love to instruct through the Montreal Exchange for all of these different sessions. And I hope all of you enjoyed this session, and wanted to thank you all for joining me.